Can you benefit from an IPP instead of your RSP? Let's find out. So how does an individual pension plan fit into your financial plan? Well, first let's discuss what an IPP is. It is similar to a defined pension plan like one's teachers or nurses would have, and specifically designed for owners and high-level executives of a corporation. The IPP allows for tax-deductible contributions by the employer or a corporation to go into a tax-deferred investment account compared to reinvesting these dollars into a passive investment in the corporation, which could affect your small business deduction limit. As an added bonus, there's an enhanced creditor protection with an IPP compared to just the corporation itself. The IPP can also provide benefits for past service contributions to catch up on unused room, providing potentially large one-time lump sum tax-deductible amounts for the Corp and into that IPP depending when the IPP is created. Who's that IPP right for? Typically, a person who's 40 years or older earns about $100,000 of income or more each year and wants to accrue some investments outside of their corporation, and possibly also looking for creditor protection. Why could an IPP work best for you? As mentioned, you can contribute more to an IPP over time compared to an RSP. For example, in 2020, 40-year-old person has the RSP limit of $27,230. However, the IPP and the same person can put $34,900 into the IPP. This amount increases and stays above that RSP limit each and every year. Once deciding to retire, there are three options available to that IPP owner. They can take a monthly pension paid from the IPP with the company assuming the liability to maintain the pension for that IPP holder. Not very common. Second, they can purchase a life annuity contract, which is a guaranteed pension for life, which can include a survivor's pension benefit, which is also not very common right now due to our really low interest rates. Lastly, the IPP owner can commute the pension amount, meaning to take that money out of the pension, which is the most common option. The funds from the pension are then paid out as a portion of cash to the owner, which is taxable, and into a locked-in retirement account, which in Alberta can be split into a RIF and LIF upon retiring. Usually, this means a certain amount becomes taxable immediately from that cash portion, but if the objective is estate maximization along with investment withdrawal flexibility, this is often the most common option of retirement income. If you have questions or want to see a video on another topic, please comment below, reach out to myself or another CFP professional to see if this strategy works for you. I'll see you next time.